WeWork. How a desk rental scammed the world. Out of $47 billion, WeWork was valued at $47 billion. It rented desks. That's it. Rented desks. And somehow the smartest investors in the world believed it was worth more than Boeing. And once you understand how WeWork pulled that off, and how it all fell apart in just 6 weeks, you will never look at a startup valuation the same way again. Today, we are breaking this story down into 4 parts. Part 1, the man behind WeWork and how he convinced the world he had built something revolutionary. Part 2, the money that made the whole illusion possible. Part 3, the moment everything unraveled. And Part 4, what this story teaches us about the difference between a great story and a great business. Let's get into it. Part 1, the man and the vision. To understand WeWork, you first need to understand Adam Neumann, because WeWork was not really a real estate company or a tech company. WeWork was Adam Neumann. And Neumann was unlike anyone the startup world had ever seen. Born in Israel in 1979, he struggled academically, tried multiple business ventures that went nowhere, and was selling baby clothes in New York by his late 20s. But Adam Neumann had one extraordinary gift. He could walk into a room full of skeptical people and walk out with their complete belief. In 2010, he co-founded WeWork in New York City. The idea was straightforward. Rent large commercial spaces, divide them into smaller units, sublease to freelancers and startups who needed flexible workspace without long-term leases. You might be wondering, hasn't that basic idea existed for decades? Yes, it had. But here is what made Neumann different from every other person running a co-working space. He did not pitch WeWork as a real estate business. He pitched it as a movement. Neumann spoke about WeWork with the language of revolution, changing how people worked, how they connected, how they built community. He talked about elevating the world's consciousness. Investors were not buying office space. They were buying the future of human work itself, and people believed him. By 2015, WeWork was valued at $10 billion. Locations kept multiplying. The brand kept growing. And Neumann kept talking. But WeWork's rise had almost nothing to do with its business model and almost everything to do with one 12-minute meeting. And that meeting is where everything gets truly unbelievable. Part 2, the money. In 2016, Masayoshi Son, the founder of SoftBank and one of the most powerful investors in the world, visited a WeWork location in New York. The visit lasted 12 minutes. And at the end of it, Masayoshi Son committed to investing billions of dollars into WeWork. He said he sensed the same crazy genius in Adam Neumann that he once sensed in Jack Ma before Alibaba became one of the most valuable companies on earth. You might be wondering, how does someone make a multi-billion-dollar investment decision in 12 minutes? The answer is SoftBank's Vision Fund. In 2017, they raised the largest private equity fund in history, $100 billion. With that much money to deploy, the pressure to move fast and invest big was enormous. SoftBank ultimately poured over $10 billion into WeWork, and that money changed everything. With essentially unlimited capital, WeWork expanded at a pace that made no rational business sense. Locations in cities around the world, thousands of new employees, massive long-term property leases signed at a dizzying rate, and they lost money at a staggering pace. In 2018 alone, WeWork lost $9 billion. And the business model had a structural problem that no amount of hype could fix. Here is the core issue. WeWork signed long-term leases, often 10 to 15 years, with landlords, then subleased that same space to members on short-term, month-to-month contracts. Think about what that means. WeWork was locked into paying rent for a decade, but their customers could leave tomorrow. The moment any economic pressure hit and businesses started canceling memberships, WeWork would still owe years of lease payments with no income to cover them. It was a business model built on the assumption that nothing would ever go wrong. And then everything went wrong at once. Part 3. The Collapse. In August 2019, WeWork filed its S-1, the financial disclosure document required before going public on the stock market. For the first time, investors and analysts could see the actual numbers behind all the hype, and those numbers told a completely different story. WeWork had lost $900 million in just the first 6 months of 2019. It had billions in long-term lease obligations. And buried in the document were details about Adam Neumann's personal behavior that raised serious alarm bells. Neumann had borrowed money from WeWork to buy properties he then leased back to his own company. He had trademarked the word "we" personally and sold that trademark back to WeWork for nearly $6 million. He had structured his voting shares so he had almost complete control regardless of what other shareholders thought. The reaction was immediate and devastating. Analysts tore the filing apart. Journalists wrote scathing pieces. The $47 billion valuation began collapsing in real time. By September, the IPO had been postponed. By October, it was canceled entirely. And within weeks, SoftBank, the company that had invested billions after a 12-minute meeting, was engineering Adam Neumann's removal as CEO. Neumann walked away with a package worth approximately $1. $7 billion. The employees who had believed in the mission and accepted stock options as part of their compensation received almost nothing as those options collapsed to zero. WeWork's valuation went from $47 billion to less than $8 billion in a matter of weeks. Part 4. The Lesson. This is not just a story about one charismatic founder who got too big for his boots. This is a story about a systematic failure of judgment at every level of the business world. SoftBank invested billions after 12 minutes. Major banks agreed to underwrite the IPO without asking hard enough questions. Employees believed the hype without examining the underlying economics. And WeWork sustained the illusion for as long as it did for one reason only: money. As long as the capital kept flowing, nobody had to confront the fact that the business model did not work. Everyone around WeWork had a reason to believe the story. The investment banks collecting fees had a reason to believe. SoftBank executives had a reason to believe. Employees with stock options had a reason to believe. Nobody wanted to be the person who said, "This does not make sense." Adam Neumann understood human psychology better than almost anyone in that room. He gave investors a story, a movement, a mission. The problem is that eventually a story runs out, and when it does, the only thing left is the business. WeWork's business was renting desks, and $47 billion was a lot of money to pay for that. WeWork did not collapse because co-working failed. Co-working spaces still exist, and many are profitable today. WeWork collapsed because it confused a great story with a great business. And the most important lesson from this entire story is this: every time you hear a valuation that seems impossibly large for what a company actually does, ask one simple question. What happens to this business when the money stops? If the answer is, it collapses, then the money was never building a business. It was just delaying the inevitable. If you enjoyed this breakdown, subscribe to Brand Autopsy. Every week we uncover the real stories behind the biggest business successes, failures, scandals, and collapses in history. Because the truth is almost always more interesting than the headlines.